Zach's Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. We're going to talk about increasing sales and margins with our top stock screener, Kevin Matras, here at Zach's. Hopefully increasing sales and margins in exchange for big profits, right? Big returns.
Right.
So this is a screen that you bring out generally around earnings time.
Right.
And that's because why sales and margins are so key to earnings for companies?
Yeah. I mean, it's a big thing, very important, critically important. But during earnings season, it seems like earnings always grab the bulk of the headlines. Mm-hmm. But, you know, sales are really the most important thing out there because, I mean, without sales, you wouldn't have any earnings to speak of.
Right.
And the earnings that everybody talks about, those are directly derived from the profit margins on those very sales.
Yeah, and you say margins are generally overlooked by investors.
Yeah, they are. I just don't think enough is written about the sales portion of it or the margin portion of it. And since there's still, I think, like half of the earnings season left, this is something that that investors, I think, need to pay, you know, a great deal of attention to. And again, you know, sales is pretty easy to understand. Everybody understands that concept.
Right.
Margins may elicit some questions from some people, but very simply, if you're looking at increasing sales, that is generally going to show you how well a company is performing. Mm-hmm. But just because sales are increasing, that doesn't necessarily mean that profits are increasing as well. And to make a long story short, sales at the expense of profits doesn't work, and that is why it is so critically important to pay attention to.
And for those who don't know, what is margin?
Yeah, I've got a slide here, but margin, very simply, is a ratio, and the calculation is net income divided by sales. So if a company's margin is 15%, for example, that means a company's net income is 15 cents for every $1 of sales the company makes. But if a company's expenses are growing faster than their sales, this, of course, is going to reduce their margins. So in general, if a company's margins are increasing, that means they are becoming more profitable, and it also means that management has a good grip on expenses. But again, with earnings season still in full swing, I just think that that when a company releases their numbers, an investor really needs to dig deeper. Take a look at their earnings, but take a look at the sales and take a look at the profit margins, because if you see a company's profit margins coming under pressure, mm-hmm. that could determine whether or not the market is going to buy those earnings or whether they're going to sell those earnings. And a perfect example, I don't want to pile on to Apple, but Apple's margins have come under pressure for 3 quarters in a row. Don't think that the pricing pressure that you've seen with Apple isn't correlated to the margin pressure that they are experiencing. Mm-hmm. So that is a perfect illustration showing you just how important margins are to a company's health.
Okay, set up the screen.
Yeah, this screen, it's pretty simple. Let me go through each one of these items. First one I'm looking for is I want the 12-month trailing sales growth, which is basically the current quarter versus 1 quarter ago, to be greater than the median for its industry. So very simply, we are looking for the top companies within its group. The next one is I want the current net margin to be greater than the 5-year average net margin. So we want to see a steady increase in their profit margin. Mm-hmm. But then taking this a step further, I also want to see the current net margin greater than the net margin from 1 quarter ago. So not only are we looking at a steady increase, the current margin over the 5-year average, I also want to make sure that the margin from the most recently reported quarter is higher than the previously reported quarter. Because if margins came under pressure in the previous quarter, there is a greater chance that you're going to see margins come under pressure again. Likewise, if you saw margins increase last quarter, there is a higher probability that they're doing something right, and you may see margins expand once again. So we are excluding anything where margins have contracted in the last quarter.
Okay.
And then we're applying everything to companies with a ZAX rank of a 1. Obviously, those are the best companies. Those are the ones rated a strong buy. So it's a simple screen, but it's a screen that's going to put a lot of top candidates on your radar.
Speaking of which, what stocks came through?
I think there was about like 30 companies that came through. Here's 5 of them. You've got American Vanguard, B&G Foods, Hertz Global, Pinnacle, and then Tyler. What's cool about this screen is that each one of these companies has a ZAX rank of a 1, which makes it a buy in its own right. All of these companies are looking at increasing sales growth, which is, in my opinion, vital to a company's health. But all of these companies are experiencing margin expansion, which means more of their profits for every dollar of sales is falling to the bottom line, and that's exactly what you want to see.
On either of these?
No.
Okay, check out our text version of this week's Screen of the Week on our website, zax.com. Link to it right off the homepage if you're not there already watching this video. With Kevin Matras and the Screen of the Week, I'm Terry Ruffalo.